Hi, Rising Tide clients. For those of you who have not met me, my name is Marcus Boadle, and I'm here at Rising Tide working alongside Sam Jewell. And here today to give you a quarterly performance update on the High Growth Index Fund, which is relevant to many of you who have a long-term share market investment. And by that we mean long-term 6, 7, 8 years plus. This can either be inside your superannuation fund, inside a generation life investment bond, or a premium account, and really means that we are invested in the share market. 90% of your funds that sit inside this are invested in the global share markets, which I'll touch on a bit later. So we just received the September quarter numbers. And so for the September quarter, we saw a pullback in global share markets in this investment, down 1.2%. Okay, now we of course don't like seeing that. When we do see this, it's important to connect with long-term performance and expectations, and also what we own underlying in this asset, which I'm going to do over the next few minutes. So we can see long-term, we expect a return of around 8%. To 9%. That's certainly what we've seen inception and the last 10 years, and what we saw year to date. Over the last 12 months, the share market has had a very good run, up almost 15%. So part of the September quarter is just the natural ebb and flow of the market, and certainly nothing to be worried about. What we'll do now is just connect with the underlying sort of components of this, which is Australian shares and international shares. And collectively, these make up almost 80% of this environment. So what we'll focus on. So the Australian share component for the quarter was down just under 1%. Okay, very similar long-term expectations to the overall fund, of course. Next is the international shares, and so as I said, made up of two components. The first one is hedged, so we remove currency from the equation. Performance here was down around 2.5 to 3% during the September quarter. Okay. Now, if we look at that in Australian dollars, performance was roughly flat. So a good thing we had some invested overseas and hedged, and some invested in Australian dollars. And the reason for this flat performance here is really that the weakness in the Australian dollar that we saw over the quarter softened those losses, which gave us this sort of close to flat return. Okay, so again, September performance down 1.2%. A bit of volatility returning to the share market, but within expectations, and certainly nothing to be concerned about, and important to connect with that long-term performance, which we'll expect to see again over the next 10 years. Now, what is beneath this layer is the actual companies that we own. Okay, so we're not necessarily invested in some of these platforms. We are invested in these companies you can see on the screen here. And this is your top 15 holdings, which represent around a quarter of your overall investment. The other is made up of thousands international shares. But these are, of course, the big ones, which I'm sure you will identify with many of them. There is a home bias here in Australia with BHP and the big banks and CSL, but you can see those large international companies that we all know and use, Microsoft, Alphabet, which is Google and YouTube, Amazon, of course, Nvidia, which is in every single they make chips in all the devices we use, and a few more Australian companies down here, Wesfarmers, which is largely Bunnings, and Telstra. So these are the high quality blue chip investments that you're invested in. And really are reflective of the Australian international share markets and their market cap weightings. Now, lastly, just reconnecting with the performance and giving some commentary around why we've seen this drawdown. And look, many participants will give you 101 reasons as to why we saw this drawdown. And one of those, very simple, is that the market just ran really hard into the September quarter. And that was really driven by, the central banks getting inflation under control. That was coming down, which gave the market some confidence. But, the real reason here is that central banks are suggesting that inflation is a little stickier than we once thought. So interest rates will have to stay where they are for a little bit longer. And that's just caused a bit of pause and volatility in the share market, but is, again, certainly not out of expectations with where we expect these investments to go. So we'll leave it there. I hope it's been beneficial and insightful. You'll hear from me in this format again in January with the next quarterly update. With any questions on this or anything else investment related, please reach out and be happy to take any questions. Cheers, bye.